Let's take a look at what happens to markets in the presence of international trade. We'll begin by looking at what economists call autarky, that is, the equilibria that exist in the absence of trade. We'll look at two countries, the United States and Brazil. To talk about a market in the context of trade, we have to clarify what we mean by demand and supply. So now that we're thinking about trade, when we talk about demand, what we mean is domestic demand. That is, demand for the product by consumers within the country. When we talk about supply, what we mean is domestic supply, the supply of the product by producers within the country. So if we look at the market for dairy products in the United States, in the absence of trade, what matters is the domestic demand and the domestic supply. The intersection of the domestic demand and domestic supply gives us the equilibrium in the United States in the absence of trade. We have an equilibrium price of dairy products of $2. We can do the same thing in Brazil, where the domestic demand means the demand for dairy products by consumers who are located in Brazil, and the domestic supply means the supply of dairy products by producers who are located in Brazil. The intersection of domestic demand and domestic supply gives us the equilibrium for the market for dairy products in Brazil when there's no trade. And we see the equilibrium price of dairy products is $4. When we think about the prices, let's assume for simplicity that we have converted them to the same currency. So clearly Brazil uses a different currency than does the United States, but there is a conversion that we can perform to put both of the prices into the same terms. Let's assume that we've already done that. So when we say $2 and $4, we're talking about dollar measures that are in the same currency. Now, if we allow these two countries to trade, it seems clear that what will happen is that the United States will export dairy products to Brazil. The reason for this is that the price of dairy products is lower in the United States, $2, than it is in Brazil's $4. So when we allow the countries to trade, Brazilian consumers can now access dairy products more cheaply from American exporters than they can domestically. So Brazil will import dairy products. Similarly, American producers were selling for $2, but now that they are able to trade, they see that the Brazilians are paying $4, so the American producers have an incentive to export to Brazil, where they can get $4 instead of $2. What will happen is that the price will settle somewhere in between, let's say, for example, at $3. $3 is the equilibrium price on the world market. And we can see that by asking the question, what is the quantity demanded and quantity supplied in each of the countries when the world price for dairy products is $3? Let's look at the United States first. When the world price of dairy products is $3, American consumers are willing to purchase 9 units of dairy products, and American producers are willing to produce 13 units of dairy products. This results in what looks like a surplus of dairy products. However, since we're thinking about the context of trade, this surplus, rather than driving the price of the product down, instead will be exported onto the world market. Meanwhile, in Brazil, at a world price of $3, Brazilian producers are willing to produce 3 units of dairy products, while Brazilian consumers are willing to consume 7 units of dairy products. This results in what would otherwise be a shortage of dairy products in Brazil. But in the context of trade, rather than this shortage driving the price up, the Brazilian consumers now turn to the world market to satisfy their excess demand for dairy products. We have a world equilibrium because the total quantity demanded of dairy products in the two countries equals the total quantity supplied of dairy products by the producers in the two countries. That is, the surplus of dairy products that the United States exports exactly balances with the shortage of dairy products that the Brazilian market needs. Now, to see how we ended up with this world price of $3, imagine that the world price isn't $3 but $3.50. If the world price of dairy products is $3.50, American consumers are willing to consume 8 units of dairy products, while American producers are willing to produce 14 units of dairy products. This surplus of 6 units of dairy products, the Americans now export onto the world market. Meanwhile, at a world price of $3.50, Brazilian producers are willing to produce 4 units of dairy products, while Brazilian consumers are willing to consume 6 units of dairy products. So Brazil satisfies this, what would otherwise be shortage of dairy products, by importing 2 units of dairy products from the world market. Now look at the quantities of demand and supply on the world market. The total quantity demanded of dairy products on the world market is 14, but the total quantity supplied of dairy products on the world market is 16. On the world market, we have a surplus of dairy products. This surplus of dairy products on the world market will drive the world market price of dairy products down. And the world market price will fall until it reaches the $3 mark, at which the world quantity demanded of dairy products equals the world quantity supplied of dairy products. Similarly, if the world price of dairy products is less than $3, we'll have a world shortage of dairy products, and the world shortage will drive the price up back to the $3 level. Now we can use our tools of consumer surplus and producer surplus to ask the question, who's better off and who's worse off in trade versus in autarky. In the autarky case, where there's no trade, in the United States, the equilibrium price of dairy products is $2, and we have a consumer and a producer surplus. This is the total benefit to consumers and producers that results from the transactions in the market for dairy products. Meanwhile, in Brazil, the equilibrium price of dairy products is $4, and the Brazilians have a consumer surplus and a producer surplus for dairy products, and this represents the net benefit to Brazilian society from the transactions in the Brazilian market for dairy products. Now, when we open the markets for trade, the producers and the consumers in both markets face the world price of $3 for dairy products. Let's look at the market in the United States. At a price of $3, the consumer surplus is everything above the $3 price and below demand. The producer surplus is everything below the $3 price and above supply, but remember that the quantity sold is now 13 units because producers will export this surplus onto the world market. So in comparing the consumer and producer surplus for the United States prior to trade and after trade, we see that the United States is better off after trade. The total market surplus is increased. Now, this might lead you to the suspicion that if total market surplus is increased for the United States due to trade, that the market surplus has declined for Brazil. That is, if the United States gained something, Brazil must have lost something. Let's look at Brazil before and after their markets are open to trade. In autarky, the Brazilians have a certain consumer surplus and a certain producer surplus. When they open their markets to trade, they now trade at the world price of $3. Consumer surplus in Brazil is everything above the $3 price and below demand. Producer surplus in Brazil is everything below the $3 price and above supply. Comparing before and after, we see that the market surplus in Brazil is greater than it was in autarky. So not only have the Americans benefited from trade, but the Brazilians have benefited as well. And in this scenario, the Americans are exporting a product to the Brazilians. In other markets, the Brazilians are exporting products to the Americans, and in those markets, again, both the Brazilians and the Americans end up with greater market surplus than they'd have in autarky. The conclusion here is that trade is not a zero-sum game. Both societies benefit from the trade. There are individuals who may be worse off. For example, there are Brazilian dairy farmers who are now out of work because they can't compete with the world market price of $3. But balanced against that are Brazilian consumers who are benefiting because now they can obtain dairy products at a much lower price than they paid before. Similarly, in the United States, there are some consumers who are worse off because now they have to pay a higher price for dairy products than they did before. But there are American producers who are better off because they're getting a higher price for their milk than they did before. What's important is that on the net, in each society, those who lose because of trade are more than outweighed by those who gain. So as a whole, the societies are better off.